You are currently on hold for the Olson & Bird IRS webinar series. At this time, we are assembling today's audience and plan to be underway shortly. We appreciate your patience and please remain on the line. Hello and welcome to the Olson & Bird weekly webinar series, Making the Most of Tax Reform. Today's session is Base Erosion and Anti-Abuse Tax. Today's conference is being recorded. At this time, I'd like to turn the conference over to Scott Harty. Please go ahead, sir.
Thank you. Good morning, everyone, and thank you for joining us again. My name is Scott Harty. I'm a partner in the Federal and International Tax Group with Olson & Bird, and this morning I'm joined by my partner, Ryan Kelly, who's based in our Washington office. And today we're going to be discussing the base erosion and anti-abuse tax under Section 59A. And next week, just as a preview, Sam Kaywood's going to join us for a couple of weeks to address GILTI and foreign tax credit issues. So we'll do a bit of an international segment for several weeks. If you are interested in any of the prior presentations, just note that those are available on our website, so you can listen to those if you like, and then some of those slides are available as well. So the agenda for today is we're going to review, just provide an overview of the BEAT, and then we're going to take a look at just some specific issues under base erosion payments and the scope of that, and then go into a few planning considerations after that. So maybe a bit of a broken record, but our goal overall is to provide a general overview of these topics and issue spot, raise issues that may be of interest to you. So given the complexity of this particular topic, there's probably issues that we are not going to address that I'm sure some of you are knee-deep in. But as always, if you do have questions, please do send those to us at any time during the call. We'll try to answer them. If we don't answer them during the call, we will definitely respond via email. And those questions, if you do submit them, are only sent to us, so none of the other participants can see those. You just need to type the question in the Ask a Question box on your screen. We're going to do our best to stay on time, and so there's a chance we will go longer just given the magnitude of this topic. But we've tried to provide some slides that you can take away and give you a little more information. So with all that, let me introduce Ryan, and then we will get started. So Ryan practices in transfer pricing and tax dispute resolution. He's advised multinational corporations and the U.S. government on complex cross-border transactions. And Ryan previously served as an attorney advisor in the IRS Office of Associate Chief Counsel International, where he advised the LB&I division on international tax issues and transfer pricing. So with that, I will turn it over to Ryan to get us started.
Thanks, Scott. So as Scott said, we've got kind of a complex topic today, so we're just going to give you a real high-level overview. If we start out here on slide 4, the overview slide, we begin by saying, the BEAT came around at the end of 2017, December of 2017, with the tax reform that was set forth in the Tax Cuts and Jobs Act. Specifically, BEAT set forth in Internal Revenue Code Section 59 Cap A. Some people have referred to the BEAT as a base erosion minimum tax, and it's a minimum tax where the preference items that are added back to the tax base are tax benefits from certain cross-border related party payments and transactions. At a high level, the BEAT operates to require U.S. corporations to pay a certain percentage of tax without regard to certain tax benefits. And so the BEAT generally requires applicable taxpayers to pay a minimum tax at an applicable BEAT rate starting this year at 10% and going through 2025, and then in 2026, the BEAT rate that applies would increase to 12.5%. And so you might be curious, what's the BEAT's purpose? Why did Congress implement the BEAT? And so the BEAT really was intended to prevent large U.S. corporations from using deductible payments made to foreign-related parties to base erode their U.S. corporate tax liability. And the BEAT specifically targets payments such as interest, royalties, and high-margin service payments to foreign-related parties that could be used to shift profits outside of the United States. And so now we'll move on to slide 5, and this slide asks us to whom does the BEAT apply? Well, a key issue for BEAT is whether or not a taxpayer is considered to be an applicable taxpayer within the meaning of the statute. And the reason for that is there's a lot of tax planning considerations for BEAT that kind of consider ways to avoid being considered an applicable taxpayer under the statute. And so again, the BEAT applies to applicable taxpayers, and that's defined in the statute based on three criteria. One, you've got to be a corporation that's other than a regulated investment company, a REIT or an S corporation. 2, you've got to have average annual gross receipts of at least $500 million for the 3-year period ending with the preceding taxable year. And 3, you've got to have a base erosion percentage of 3% or higher for the taxable year. And I'll just note that for entities that are either banks or securities dealers, the 3% threshold is actually lowered to 2%. So now we go on to slide 6, and we ask, how does the BEAT actually get calculated? And I'll just tell you that the BEAT calculation is very complicated. It's very complex, and based on the statutory language, there's a lot of ambiguity in there, and a lot of taxpayers have had to model their BEAT calculation and exposure using certain assumptions. But for purposes of this presentation, we'll just give you a very high-level overview. BEAT formula at a very high level is a kind of a 2-part equation. The first part is the BEAT tax rate times modified taxable income. And modified taxable income is determined without regard to base erosion tax benefits and the base erosion percentage of any NOL. The second part of the calculation is essentially subtracted from the first part. And to determine the second part, that's the taxpayer's regular tax liability computed under Section 26 minus various credits or credit adjustment. And I'll just note for purposes of the credit adjustment, foreign tax credits don't necessarily receive preferential treatment under the BEAT. So if you're a taxpayer and you have BEAT liability, foreign tax credits may not be a good thing anymore because ultimately they could increase the amount of BEAT that the taxpayer owes. So again, that's kind of a high-level overview. We've also got slide 7 here, which sets forth the base erosion tax benefit, the definition of a base erosion tax benefit, one can generally think of base erosion tax benefits as the tax benefits that are allowed with respect to a base erosion payment. And then there's four other bullets that specifically underneath that. The last four bullets kind of set forth other areas that there are items that are considered base erosion tax benefits. And so the reason that we care about the base erosion tax benefit is because it's an important component for not only calculating modified taxable income, but the base erosion percentage itself. Again, for purposes of this presentation, just kind of a high-level overview of the components that go into the BEAT calculation. The calculation itself is very complicated and beyond the scope of this presentation. So now let's move into what is actually considered the scope of a base erosion payment. If we go to slide 9, there's a bunch of bullets here on the left, 4 in particular that actually set forth the items that are enumerated within the statute as base erosion payments. And one that I want to highlight is this very first bullet that says any amount paid or accrued by the taxpayer to a related foreign person with respect to which a deduction is allowable, things like interest. That's probably going to be the kind of the bucket of or the most common area in which payments are going to be caught for purposes of base erosion payments and the BEAT statute. But again, there are these other 3 buckets that of items that constitute base erosion payments that include any amount paid or accrued to a related foreign person for the acquisition of depreciable or amortizable property, any premium paid or accrued to a related foreign person for certain reinsurance payments, any amount paid or accrued to a related surrogate foreign corporation or a foreign member of the same expanded affiliated group as the surrogate foreign corporation that reduces the taxpayer's gross receipts. And I think that the takeaway here from kind of this definition of what constitutes a base erosion payment is that outbound payments to foreign related parties and the definition of base erosion payments are very broad. They catch a kind of a large subset of payments that many multinationals might have, but keep in mind that there are various exceptions to what are considered base erosion payments. If you look there on the right, there's 4 different categories of items that are exempt from base erosion payments. The first being payments that qualify for or qualify as cost of goods sold. The second is payment for services that are eligible for the services cost method under Section 482. The third are payments that are considered qualified derivative payments. And then the fourth are any base erosion payment that contains or is subject to withholding tax wouldn't be considered or would fall within the exception of a base erosion payment. And so, again, that's kind of a high-level overview of what constitutes a base erosion payment under Section 59 Cap A. If we go to the next slide, we can talk about the first exception to what is a base erosion payment under the COGS exception. And so, for the COGS exception and BEAT purposes, we're primarily concerned about whether a cost can be capitalized under Code Section 263 Cap A or not. And previously, this may not have been a huge concern because most taxpayers either capitalize the amount or expense the amount. But now, for BEAT purposes, if the cost is expense, then it could be caught. It basically could be caught within the BEAT regime. Whereas if it's capitalized, it falls within the COGS exception, and wouldn't be subject to BEAT. Wouldn't be a base erosion payment. So, for BEAT purposes, that's kind of why we care about can the item be capitalized or not. And so, a lot of taxpayers aren't experts in Section 263 Cap A and capitalization, but just at a high level, what can be capitalized in the COGS? A couple of things. One, all direct and indirect costs that are allocable to real or tangible personal property that's produced by the taxpayer, or real or personal property that is acquired by the taxpayer for resale. And direct costs consist of direct material and direct labor costs, while indirect costs are those that directly benefit or incurred by the reason of production or resale activity. If we go to slide 14, this kind of sets forth, based on the rules that are in 263 Cap A on indirect costs, what can be capitalized or not. And I'm not going to go through, it's kind of a lengthy list on both sides here. I'm not going to run through both of these, but the idea here is that, if you haven't taken a look at some of your indirect costs and whether or not those can be capitalized, you might want to go through and see if there's the opportunity to push some of these indirect costs into cost of goods sold. That way, you can lower your base erosion payments. Turning now to slide 12, which covers our second exception to the base erosion payment, is the services cost method exception. And so Section 59 Cap A provides that base erosion payments don't include amounts that are paid or accrued if they satisfy kind of two requirements here. The first is that the service actually has to be, their payments made for a service that are eligible for use under the services cost method under Section 482 without regard to the business judgment rule. And then two, such amounts constitute the total services cost with no markup component. And I'll make just a couple observations about this. Section 482, for purposes of applying in the transfer pricing context, the services cost method has some pretty stringent requirements, but it's interesting in that for BEAT purposes and looking at whether or not a service is eligible for the services cost method, one of the main requirements under 482 in the business judgment rule, that requirement is turned off for purposes of applying the SCM in the BEAT context. The other thing I'll note is that there are limits to certain limits that we care about for qualifying under Section 482. Those are set forth in kind of the bottom part of the slide here. It says that the services must be eligible for the services cost method. One, the services themselves can't be excluded activities under Treasury Reg Section 1.42-9B4. That's known, the list that's set forth in that Treasury regulation is known as the blacklist. And the idea when Treasury put that regulation out was that the activities listed there are in fact what Treasury considered to be kind of high value services. I'm not going to go through the whole list because it's lengthy, but things like manufacturing, research and development, those sorts of things. But again, for SCM purposes and to be eligible, the service can't be the type of activity that's listed in the blacklist. And then secondly, it's also either got to be a specified covered service or a low margin covered service. In order for the service to be a specified covered service, there's a long list in Rev Proc 2007-13. The service went through in that Rev Proc and actually listed 101 different types of specified covered services. Again, because we're limited on time today, I'm not going to cover the 101 items, but just to give you a flavor, typically services that would be categorized as low value, low margin services, things such as payroll, corporate and public relations, general administrative, staffing and recruiting, those sorts of services are considered specified covered services. And then if you've got a service that doesn't actually fall on the specified covered services list, it could still be considered a low margin covered service, which is basically any service transaction where a comparable markup on total services cost is 7% or less. So there's, again, there's several ways to kind of fall within the SCM exception, but you've got to make sure that you jump through all the hoops. So now we'll go to our next slide, slide 13, which raises a couple of different issues as far as the SCM exception and the language that was specifically promulgated under 59 Cap A and setting that exception forth. And to kind of describe this, imagine that this example where you've got a U.S. parent owns a foreign sub. The foreign sub is performing G&A services for the U.S. parent, and the U.S. parent is making payments for those G&A services. So for purposes of applying the SCM under U.S. law, you wouldn't necessarily have any sort of markup, but in order for transfer pricing purposes for the foreign related party to satisfy the arm's length standard, the foreign jurisdiction might actually require a markup on the outbound payment in order to satisfy the arm's length standard. And so amongst tax practitioners over the last several months, there's been this pretty lengthy debate about whether or not, for SCM purposes, if you're in a situation where the taxpayer factually decides not to elect SCM on the outbound payment and actually includes a small markup, let's say 5%, 5% markup on cost, would the fact that there has actually been a markup on that payment, does that exclude, for BEAT purposes, basically taint the outbound payment, all of the outbound payment, as being a base erosion payment and not being eligible for the SCM exclusion? And so that's kind of been kicked around pretty heavily, and a lot of the writings and some of the comments have gone to Treasury. Fortunately, the proposed BEAT regulations that came out back in December found a taxpayer favorable view in that they basically said if there's a small markup component on the outbound payment, only the markup component would be considered a base erosion payment, and the cost component on the outbound payment for the services would not be considered a base erosion payment. So again, very taxpayer favorable ruling. Now let's turn to slide number 14. For those of you that don't want to look at the language of the statute, this is just kind of a diagrammatic that walks you through what are the requirements to be eligible for SCM treatment under BEAT, and what amount of the outbound payment would be subject to BEAT. I'm not going to run through it because of time constraints, but to the extent you like diagrams, there's one here on slide 14 that walks you through the requirements. Now we'll turn it back over to Scott to cover slide 15.
Thanks, Ryan. So just kind of picking up on the scope of the base erosion payments, we just wanted to look at a few slides that relate to payments made by U.S. entities, U.S. persons to foreign entities in various situations. So this first one involves intermediaries, and if we kind of step back to what Ryan said initially, that the intent here is to deny the benefit of a deduction when you're essentially shifting profits to a related foreign person through deductible payments. And in a few of these slides, we'll see that in a classic sense, that's not what is happening. And so should the BEAT pick up these types of payments? And in this case, we have a situation where a U.S. entity is making a payment to a related foreign person, which is essentially acting as an aggregator or an intermediary, and then that foreign person is making payments to unrelated foreign parties. And so by acting as an intermediary for unrelated foreign parties, is there really any base erosion in the sense that Congress intended? And would it make more sense to try and disregard this intermediary or treat the payment as being made by the U.S. parent to the unrelated third party? I think that the short answer is no. The regulations and the statute don't really provide that. So nothing's going to prevent those payments as being treated as base erosion payments in this case. And so this is more of just a note for clients. You might want to review structures if you have arrangements like this, to see if there are opportunities to restructure these types of payments so that the payments are being made to the unrelated third parties. I know that's not necessarily easy to do when you've got contractual arrangements in place, not easy to amend those or revise structures, but nonetheless might be something to look at. Then another one is just payment netting. This was certainly something that was discussed before the proposed regs came out, and essentially where you have companies that often net payments where you have outbound and inbound payments, and those payments are being netted for administrative ease and whatnot. the question then arises once again, is there effectively base erosion where you have outbound payments that are offset maybe in large part or fully by a corresponding inbound payment? And if we step back and look at the purpose of the BEAT, the purpose was to address base eroding. And often in cases there really isn't a base erosion in a classic sense. Unfortunately, the regs really don't provide relief to these types of netting arrangements that may arise in maybe cash pooling or cross-licensing types of arrangements. And so there's no netting rule, and the preamble to the regs say that the statutory framework is based on including the gross amount of deductible payments without regard to reciprocal obligations that may be taken into account in their regular income tax base. So by looking at just the gross amount, we're including base erosion payments that in fact may be offset by a corresponding payment. And so this is something else to pay attention to, that there really is no netting rule, even though that may be the practice of the company. This is a significant issue that is in the regulations. Comments, probably extensive, will be submitted on the use of non-cash consideration. And so the issue here is that non-cash consideration, or in some cases, the assumption of a liability or the use of stock, may be treated as an amount paid or accrued for BEAT purposes. And so under the regulations, the proposed regulations, tax-free transactions are caught up in this. And so examples that you'll see in the proposed regulations are acquisition of depreciable assets in maybe a 351 exchange or a 332 liquidation or a 368 reorg. And so you have an acquisition of maybe depreciable assets purely with the use of stock. And we have an example here where U.S. parent owns a CFC and they liquidate the CFC in a 332 transaction, and you have a deemed exchange of the stock for the assets, and this would be picked up under the regulations, although the IRS is requesting comments. So there's really some difficult issues here as to the use of non-cash consideration in these types of transactions. And you may or may not have kind of an acquisition in the BEAT sense in some of these cases. So if you acquire assets almost as a substitute for your cash, and it really is consideration for an acquisition, that kind of makes sense that non-cash consideration should be treated as an amount paid. But if we take this example where you have a 332 liquidation, the exchange of the stock, is that really a quote payment? Is that an amount paid for the assets when the stock isn't necessarily being used on the other end? It really is canceled. So, I think there's just a serious question as to when should non-cash consideration be treated as an amount paid. And there will need to be further guidance on these issues, because there are a lot of implications under other code sections in addition to 368 or 351 or 332. The regs also mentioned 721, and then you'd have to look at 302 and 304. So you have a variety of transactions where non-cash consideration may be used that hopefully we can get more clarity. But this is an issue under the regulations.
Scott, this is Ryan. I'll just point out. This really goes back to Treasury has, cast a very wide net over what it considers to be a base erosion payment.
Yeah. Good point, and so there may not be as much wiggle room as we'd like on the use of non-cash consideration, and so that would not be surprising when the final regs come out. Before we touch on planning, just mention the anti-abuse rules. So the proposed regs provide 3 anti-abuse rules that allow the service to disregard a transaction if the principal purpose is to avoid the beat. So there's 3 that are listed here. I think the first one is just one I want to touch on. Essentially, transactions where an intermediary is used as a conduit for the taxpayer. So we were talking about an intermediary used to make payments to unrelated parties. In this case, an intermediary is being used to make payments to related parties. And the regs specifically say that the intermediary must make a, quote, corresponding payment to or for the benefit of the foreign related party. And so I think kind of we'll need clarity as to what does that mean. When is an intermediary acting as a conduit? What is that nexus that's needed between the payment from the U.S. person to the intermediary and then the, quote, corresponding payment to the foreign related party? So hopefully there'll be more clarity. Right now it's at least vague in that sense. It just says a corresponding payment. Okay, so let me just jump to some planning issues, and then we can wrap it up. Planning with check the box. This is just an issue to be considered. Where we have outbound payments that are base eroding payments to foreign subsidiaries. Would a check the box election make sense for the U.S. parent to make for the foreign sub, essentially disregarding or resulting in the disregarding of that payment, that outbound payment? I think it certainly may be possible, but there are a lot of implications that arise from a check-the-box election, one of which I just mentioned in terms of non-cash payments. And are you effectively triggering a separate beat issue by acquiring depreciable property if you just check the box on the foreign sub? But in addition to that, you've got foreign tax credit issues with respect to the new basket on branches and whether you're going to potentially capture tax credits in that basket. Also, are you triggering any additional issues? Is that foreign sub making payments that may also be treated as beat payments for the U.S. parent? So there are additional considerations in making a check-the-box election, but it's certainly an idea that should be looked into. Jump to the next one. I'll turn this over to Ryan to talk about cost sharing real quick.
Thanks, Scott. So on this next slide, this is a pretty common structure here on the left where in the cost sharing context, you've got a U.S. parent, enters into a cost sharing arrangement with a foreign sub or foreign principal, and then the foreign sub's got another subsidiary that's conducting R&D for purposes of the cost sharing arrangement. And typically, sometimes you'll have it arranged where the U.S. parent is the one that's actually making the payments because they're the ones with the cash, but they are making the payments to the R&D subsidiary for the R&D services. And so that outbound payment by the U.S. parent to the foreign R&D sub, that would qualify or be caught up as a base eroding payment. And so, one of the things that you can do for cost sharing purposes to avoid the outbound base erosion payment is just to restructure the arrangement to where the foreign principal is the actual party that's making the R&D payment to the foreign R&D sub. The reason this works is because under cost sharing, the two cost sharing participants, U.S. parent and foreign principal, would split the R&D costs. It would all be pooled and then split up amongst the cost sharing participants. So by moving the R&D or restructuring the arrangement to where the R&D payments are made by foreign principal to foreign R&D sub, economically the parties are going to be in the same place for cost sharing purposes, but again, for beat purposes, the U.S. parent's not going to have a base erosion payment on that outbound R&D payment. And so again, here it's just we asked, does it make sense to change the contractual arrangements so going forward, for the foreign principal company is the one reimbursing foreign R&D subsidiary. And so on our next slide, slide 22, this is kind of a diagram or an example that covers eligibility for the services cost method exception. So here we've got a U.S. parent and a foreign sub. The foreign sub, again, is doing G&A services activity for the U.S. parent. U.S. parent is compensating foreign sub with the outbound service payment. And so that outbound service payment, that's going to be considered a base erosion payment, can be caught up in BEAT and result in BEAT tax liability. And so here we just want to raise the point, to the extent you as a taxpayer have services that are being performed by foreign subsidiaries and you're making outbound payments, you might want to revisit some of those service transactions, service payments, to see if they are in fact eligible for the services cost method. That way they would therefore not be a base erosion payment. And so again, that's kind of a high level of some of the planning tips, some of the issues that we're seeing in our practice, and I'll turn it over to Scott to kind of give you a high level summary.
Yeah, thanks, Ryan. Let me just go back real quickly. We did get a question on the check the box slide. The slide here was intended to show a U.S. parent with a CFC, and then the parent checks the box on the CFC to treat it as a disregarded entity. And so the thinking is that the outbound payment in that sense would be eliminated because it's to a DRE. I guess one of the issues that might be raised there is what type of foreign tax credit implications would you have if you now have a DRE, you got a branch? Does that DRE now have the incoming payment from the parent would not be included for U.S. purposes, and so are you building in a potential issue of where you have structural losses flowing from the foreign branch and may capture foreign tax credits in the basket? But that was the intent of that slide. It may make sense in some cases, and we should consider the use of partnerships. There are separate rules with respect to partnerships, but would a partnership help alleviate some of those issues where you may have multiple branches and aggregating those under a partnership? So there are several considerations, but check the box should be looked at. So we're over our time. I think we have a final summary slide, but it essentially recaps what we've discussed. If there aren't any other questions, just want to thank Ryan. I appreciate you joining today and providing that summary. Next week, we will be joined by Sam Kaywood. Should be a great presentation on GILTI. And these slides will be available on the website as long as this audio. So if you wanted to listen to it or download the slides, you're welcome to do that. We appreciate you all for joining today, and we'll talk to you next week. Thanks.
Thank you.
This concludes today's call. Thank you for your participation. You may now disconnect.